Okay. Hi, Shawn.
Hi, Jamela. Hold on a second. Let me see if I got it all straight. Okay, you there?
Yep, I'm here.
Cool. All right.
So thank you so much for agreeing to speak to me about the banking industry right now. And welcome everyone to It's All About the Benjamins. This is a financial literacy series.
Love the title.
Yes. This episode is called Get Money. And my guest is Shawn Carson of the Federal Savings Bank.
Hello, everyone.
I am Jamela Swift. I'm an agent with Keller Williams NYC Tribeca. I've been in the real estate industry for about 16 years now. And usually before someone comes to me, their money has to be in order, whether it's renting an apartment or purchasing a home. They have to have a sense of order with their finances. And considering that we're in a global fiasco of a pandemic.
Yep.
A lot of people are staying up late at night sweating over their finances. I mean, no one predicted this would happen except for maybe Bill Gates 5 years ago. But here we are. And I figured it would be good to have a series of discussions on money to eliminate the fears that people have around money. So Shawn and I are here today. We're going to discuss the banking industry. And so now, like I mentioned, Shawn, you are with the Federal Savings Bank. So
That is correct.
Tell us, why would someone choose your bank over a Chase or a Wells Fargo?
Great question. So let me just kind of backtrack a little bit just to give some background. I have been in the mortgage lending business for over 17 years. And I've been in all different types of lenders. So I've been in a mortgage brokerage, which is where I started. I was at a couple of big lenders. I was at a couple of mortgage banks. And I've been at three federally chartered banks. And the reason why I chose to partner with the Federal Savings Bank is because we are not constrained like many of the bigger box lenders are. Like, we don't have just a target audience that we serve and that we don't go outside. So not to say that we do subprime loans or that we just will approve anyone, because that would be misleading. But let's just say our lending box is bigger than the big box lenders, right? So they have a target that says that you have to put a certain amount down. You have to have credit scores of a certain number, your debt to income ratio, which is basically your monthly gross income versus your debt can't be above a certain amount. So if they're here, we're here. We're not out there, but closer in. And the other reason why I'm at the Federal Savings Bank is we are a federally chartered institution, FDIC insured. We do have checking, savings accounts. We do have CDs. We do provide personal loans to our clients. But the main bread and butter of the Federal Savings Bank is mortgage lending. That's what we want to do. That's what we're good at. And that's what we're always going to push our resources towards. Whereas working at a bigger bank, and I won't say any names because I don't want to get sued, right? They have different products. And so therefore, their focus is not primarily on mortgage lending or any of their product lines. Their focus is on customer names, numbers, and email addresses so that they can cross-sell to various market segments. Like, so if you ever get a mortgage with someone, you know, in your mortgage statement, they're sending you an ad for a credit card, or also you can get a low-cost car loan or whatever. So those are what, you know, the big banks are. They just want to have customers so that they can then cross-sell your information, which is of value to them.
Okay, so then that gives me the impression that your bank is very financially secure right now, because I've been reading a lot of articles that, you know, a lot of people are unemployed, and a lot of homeowners, it's anticipated that people are not going to be able to pay their mortgage for the upcoming months.
Right.
Ultimately, that's going to affect the bond market. And then
Absolutely.
So where do you all fit with that?
Where we fit with it is, I'm not going to sit here and say that we're not going to be affected at all. We are, because we are a portfolio lender. Well, we have our own portfolio, meaning we service our own loans. Many of our loans are packaged as a security and sold on the secondary market, which is what most banks do. So when you hear about the mortgage forbearance, it's not so much that it's a strain on the bank. It's a strain on the servicing capacity of the bank, because just because mortgagees don't make their payments doesn't mean that we're not responsible for paying the investors on those loans.
Right.
So it's not like traditionally where you went to a bank and you got the mortgage from that bank and you made all your payments to that bank and you worked out any arrangements with that bank. It's a little bit more complex. Banks take those mortgages off their balance sheet and put them in another company. They own the company, but it just keeps it separate for bookkeeping purposes. So not to get too far off in the weeds, but we are very well capitalized. We
Okay.
are still lending.
Right.
Okay. We have not changed our guidelines significantly. We follow the guidelines of the agencies, which are Fannie Mae, Freddie Mac, and Ginnie Mae, which encompasses FHA and VA loans. So whatever they say that they will purchase, that'll be our minimum. We don't have any overlays. We haven't, gone off the reservation where you've got to have a credit score above whatever. You know what I mean? Like our minimum score for most of our programs right now is 640. In other environments, we could go as low as 580.
Really? Okay, that's
Yes.
good to hear because I read that Chase is, because of the pandemic, Chase has really restricted their lending requirements, and you have to
Mm-hmm.
have 700 credit score. You have to put
Mm-hmm.
50%. So
Mm-hmm.
what does the Federal Savings Bank require? Like, what programs do you have? Do you have an FHA program still?
We, we still have the FHA program with a minimum of 3.5% down. For
Okay.
those veteran eligible borrowers, we still have the VA program, which requires no down payment whatsoever. You can do 100% financing for VA. We
Okay.
still have our Fannie and Freddie Mac programs, which in some cases for the affordable program, you can do 3% down. For regular, you can do 5% down. If it's a multifamily, it might vary a little bit. You might have to put 10, 15, or 20% down, depending on what type of property and what the sales price is. However, our minimum generally is 3.5% on the FHA, 5% on the conventional side. Okay.
Okay.
And like I said, with credit scores, we're not that stringent.
Okay.
And just to kind of backtrack a little bit, because you said the name, I'm not going to say it. But when a lender comes out and says that, we've changed our lending scores to 720 and you have to put a 20% down payment, they're basically saying to you they don't want to do mortgages, right? They can't come out and say that because they're federally chartered to lend, and they can't, for discriminatory reasons, for regulatory purposes, they can't come out and say we don't want to lend. But if you're talking 20% down and you're in a jumbo lending market like New York City, where the average house is, let's say, 800,000, how many people are walking in with $160,000 that they could put down on a home that have perfect credit and that have not been affected, by this crisis? So that's a lender pulling back, saying we really don't want to be in that market segment, which is kind of what I was talking about earlier. We're focused on the mortgage market. We're not going to pull or have guidelines that are so stringent that nobody can qualify, because then we're shooting ourselves in the foot.
Right. Well, I'm happy to hear that you all are still lending. I know
Yes.
recently in one of my sales meetings, my manager mentioned that there was a buyer who was ready to proceed with his purchase. And I believe they already received their commitment letter. And
Yep.
at the last minute, due to COVID, the bank decided that they no longer wanted to fund the loan. So I
Mm-hmm.
asked you now, usually as a real estate agent, I always advise my customers when they're applying for a mortgage to get a mortgage contingency. And I
Absolutely.
put that in the deal sheet that goes out to the attorneys. Now I'm learning that we also have to request or state that the buyer wants a funding contingency. So can you
Mm-hmm.
explain to us what the difference is between the two?
Right, absolutely. So a mortgage contingency just basically says that the bank is willing to lend you the money in the near future, meaning whenever the contract of sales states that the closing has to take place, we've done our due diligence, and based on your credit and your income and your assets, that you are qualified for this loan. However, there are other conditions that have to be met, and usually they're on the seller's side. They have to deliver a clean title. They have to do, whatever stipulations are outlined in that commitment letter. Now, if anything changes between when that commitment letter was issued up until the closing date, the lender in one of those paragraphs reserves the right to cancel the funding or to cancel that commitment letter for whatever reason. Now, a lot of people don't know that, but contractually and legally, the lender is allowed to do that based on any changes in contract. So if the mortgage lending market or if the financial market changes to the point where the lender states we can no longer offer that program, it's bad business. It doesn't make for good customer service, but technically and legally, they can cancel that commitment prior to documents being signed. Now, once the documents have gone out to the closing table and they've been signed, even 30 seconds after that signature takes place, the lender cannot cancel the agreement because it has now been executed on both sides. But if there's not an agreement to lend that's executed on both sides, yes, technically a lender can cancel. Again, it's bad business, but they can do it.
So even after they close, you're saying if they didn't have a funding contingency, they can renege?
No.
No?
After they close, they can't renege. That's what I'm saying. After they close, that's it. It's done. It's all done. However, the lender can be open to certain certain punishments, if you want to say, after the deal closes. Just to give a quick example, let's say that you and I are working on a deal and your buyer closes today, Friday at 2:30 p.m. All right. And they find out at 4:30 p.m. that they are now no longer employed. They've been laid off as of today. Okay. So on Monday, they are now unemployed. Mm-hmm. However, the lender has verified that as of Friday, whatever today's date is, because I don't know when this is going to air, that this person is employed. So if we put that mortgage into a security, we are saying that we take responsibility for any information that is in that mortgage that is now inaccurate. Well, if we close the mortgage at 1 o'clock and then she finds out at 5 o'clock that he or she is now unemployed or their income has changed drastically, doesn't matter. We've secured that mortgage and we've stated to Fannie Mae or Freddie or to FHA, VA that that mortgage it's been certified. It's good to go. So if she then calls up in 2 weeks and says, I've lost my job, I can't make my payments, I'm requesting forbearance, Fannie Mae, Freddie Mac, FHA, VA can turn around to our bank and say, you didn't certify properly, so therefore you have to buy this mortgage back. And so what lenders are afraid of is not so much homeowners that have been in their mortgages for 2 years, 3 years, 4 years. It's people that have closed within the last 90 to 120 days because there's a buyback provision in all mortgages which state if anything changes within 120 days, you got to buy this back. So now it comes back onto your books and you give us back the money that we just paid you. And that's the reason why people are constricting and contracting in the lending market because they don't want to be open to that happening.
Wow.
Got it?
Okay.
Right.
Well, that's good to know.
Right.
So, okay. Now let's say if I refer someone to you,
mm-hmm.
they submit an application,
mm-hmm.
and what are any red flags that you would notice that would cause for you to deny their application?
Right. Now, red flags, and this is for any bank that, any client is working with, so keep this in mind. A lender cannot decline a mortgage based on potential red flags. They cannot. So what I look at is what industry are you in right now? If the buyer is in the retail industry, that's not a good industry to be in at this particular moment, but that doesn't mean that you're not qualified or eligible, for financing on a mortgage. Because if you are employed, as we just stated, up until the date and time of the closing, doesn't matter how shaky the retail industry is, we still have to close that loan. However, what an underwriter is going to look at is the reasonableness of continued employment or continued income. And then they're going to look back over the history. Did this person just start this job maybe a year ago? Because again, last in, first out. If you're like one of the last employees hired, if they're going to do furloughs or layoffs, it goes by seniority. So if you don't have the seniority, it's going to be expected that if layoffs take place, that you would be one to be laid off. So they're going to ask for extra verifications. They're going to want to speak to your employer. They're going to want to find out what's going on. And then they're just going to use their judgment. They can't come out and say, well, you're declined because you're in an industry that's kind of shaky. But if we can't verify that there's a reasonableness that your income is going to continue, yes, you can be declined. So that's one red flag. The other red flag is if you've had multiple inquiries in a short period of time. Just across the board, that's a red flag. But particularly in times like this, it's pretty much like, okay, have you applied at 6 different places and got declined? Or looking at the type of inquiries, if it's all consumer credit, if I see lending club or any other personal, loan company, that's going to state, okay, do you have the funds to purchase this home? Are you robbing Peter to pay Paul? Are you borrowing here to put the money down there? So all of those different things are looked at, but there's not really much different. It's just looking at income and debt right now, and credit scores. So all three of those are kind of tied in together, but the most important thing that everyone is looking at is what is your reasonableness that your income is going to continue. That's really what the biggest red flag is right now.
Okay.
Okay.
Well, I'm sure you, like myself, you get clients that come along and they may not be ready to purchase today.
Right.
Especially considering the climate that we're in. But
right.
If they would like to, they have a dream of owning a house
right.
in the next couple of years.
Mm-hmm.
But their credit is jacked up.
Mm-hmm.
They don't have any money to put
right.
To make a sizable down payment. What would you advise them to help them along the way to start preparing them for the approval process?
Right. Good question. I do work with people both in the short term and the long term. So on the long term, we'll develop a strategy. Let's take a look at what your weaknesses are and see how we can turn those into strengths. Right. So, for example, if the person's credit is not as good as it needs to be to qualify for a mortgage, which is the biggest impediment that I have, with people not being able to qualify for a mortgage. Let's just take a look at why the credit score is what it is. There may be a medical collection that's been sitting there forever that's been paid off and you don't even know that. Or you could have applied for one of those credit cards. I was going to say the bank name, but I caught myself, where they give you a $250 limit. Mm-hmm. And then as soon as you use $150, your thought process is, well, I only used $150, but that $150 is more than 50% of the available credit on that credit line. So your utilization percentage is high, which moves your credit score lower. So it's better to have a $3,000 balance on a card that has a $10,000 credit limit as opposed to a $150 balance on a card that has a $250 credit limit. As silly as that sounds, because you have more debt outstanding, but you have more available debt, which is what the credit system looks at. So that's the first thing we want to do, is to clean up the credit. The second thing we want to do is just to kind of, help them develop a realistic time frame or realistic, I should say, goal. Because if you want to purchase $1 million home, but your income is below $70,000, chances are that's not going to be possible. Yes, you can purchase a multifamily and use potential rental income, but I always caution people in times like these, highlight exactly what that caution is. If your tenants, for whatever reason, are not able to pay, you still have to pay the mortgage. You can't go to the lender and say, well, my tenants haven't paid, so I can't pay you. It's still going to affect you. So I always tell people it's great to have a multifamily for the additional income, but you don't want that to be your primary source of qualifying income. So I always tell people, let's look at that. And the third thing is, whether they work with me or not, I'm great with giving out information. There are so many down payment assistance programs and grants that are available in usual climates that most people do not take advantage of. In New York City, a lot of people don't qualify because the limits are they're so unrealistic right now. It's pretty much like if you qualify for the income, you're not going to be able to afford to purchase anything. And if you can afford to purchase it, then your income is probably above the guideline maximum. So what I'll do is I'll work with people to develop a strategy on how they can find some money that can help them towards the down payment, and then to come up with a savings plan, working with them and then referring them over to a lot of the community-based organizations that have savings matches for new homeowners. So if you open an account with a certain bank that may not do mortgages, they may be just a credit union that doesn't do mortgages, but they'll do a match. So if you put $5 into a savings plan, almost like a holiday plan or a Christmas plan, they'll match it, dollar for dollar. so that you can, then purchase a home. And for doing that, they get money from the federal government. So they're not doing it out the kindness of their heart. They're looking for people to match money with, so they get more money from the government. So those are the types of things that we'll look to do, and we'll develop a plan, and then I'll put them on my email blast. And then I'll also put reminders for myself, please call back Mr. Robinson in 6 months. He'll be ready, maybe in a year, and just keep them on a drip campaign so that, we're staying in contact with each other. And then sometimes on Wednesdays, that's my pre-qual day. I'll just call people I pre-qualified 6 months ago and say, hey, how are you? Not, are you looking to purchase a house, or did you purchase? If so, congratulations, and still send you a congratulations gift or whatever, because I just love what I do. So I love staying in contact with people. Anytime somebody, purchases a home, it's almost like the nurse that works in the OBGYN unit. When a new baby comes along, they're excited. So anytime somebody purchases a home, I'm excited about it because I know the benefits that home ownership bring, along with it.
Absolutely. And you know what? I'm so happy that you mentioned that, buyers should not be too reliant on the tenant's income. I remember back before the 2008 crash, I remember taking buyers out, and their lenders would tell them, well, you can afford $700,000, as long as your tenants pay. And I looked at them and I said, well, what if your tenants say, no, Roger, no.
Can't pay, right. Right. What's happening? Yeah.
Everybody's going to remember that reference.
Right. But we do.
What if they say, what? Especially now, there are rent strikes being planned in New York City.
That is correct.
So I tell people, always purchase a property as if you're going to live there as a single family.
Right.
You don't want that strain of having to rely on your tenants because, the relationship could go south.
That's correct. Things happen.
Friends 1 minute, and then the next thing you know what? We don't have to pay.
That's right.
That's right. In New York City are, on pause for 90 days.
At least.
Yeah, exactly.
At least, right.
So, one last question for you, Shawn. What about the PPP and SBA loans? Is your bank, are you guys working with your customers securing those loans?
We do not do PPP loans because we're not an authorized SBA lender. Okay. But again, I'm always one to pass on information to anyone. And so what I do advise clients to do is to work with smaller local lenders that concentrate on small business and commercial loans. The reason being is because many of those lenders are still liquid through the PPP program, because I'm sure everyone has heard that the first round ran out rather quickly. Right. And it ran out rather quickly because the larger lenders, which again, I won't say their names, right, who work with the larger companies who have subsidiaries, were funding their subsidiaries. So they were not necessarily funding the major shack, if you can follow where I'm coming from. They had subsidiary companies that were being funded instead. And so therefore, those companies work with the major lenders. They have relationships with them. The CEO of one company goes out with the CEO of the bank for golf and all of those different things. So a lot of those funds dried up rather quickly, whereas your local lender, they're hungry for your business. They're going to do things to get your business. They're going to have consultants in the branch that are going to help you to build your business. Not only do they have the PPP loans, but they have access to other emergency funds and emergency loans that are available on the state and local levels that, were already in place prior to this that nobody really accesses. So there are things that you can do in order to kind of like ride through this process. My biggest concern with that is I just don't want to see small businesses go away because they are the heartbeat of this country. I know, when we turn on the Dow Jones average, we're looking at larger corporations, but that's not what this country is made up of. It's made up of small businesses, that feed into those larger companies. And so we have to do whatever we can to keep small businesses going.
You're absolutely correct on that. I mean, I love the local restaurants in my neighborhood because they lend to the community,
Right.
seeing everyone, working there, and they know who you are. It's kind of like Cheers,
Right, right, right. Everybody knows your name. Absolutely. Right.
Well, thank you so much, Shawn. I really appreciate your time.
No problem. Thank you for having me.
Yes, and to everyone who's watching, thank you for watching this today. Please forward it to your friends and your family, and also look out for additional videos that I have coming up. I'm going to be speaking to an estate planner on getting your affairs in order. I have financial advisors that are going to talk about securing your assets, especially in a pandemic crisis. So, Shawn, I'm going to have your information listed below this video.
Perfect.
Anyone
Perfect.
has questions for you, they can contact you. My information will be detailed there as well. So thank you so much. Have a great
Thank you. You too. Stay safe.
Yes, you too. Okay.
Okay. Bye-bye.
Bye.